Hey everyone, this is Kirk here again at Option Alpha. In this video, I'm going to show you how to run a 0DTE backtest. We're going to go step by step and go through multiple examples. So first thing that we do is we go into the new backtester, then we click up here in the top right to run a new backtest. Now this is where you're going to set up all of your parameters for your backtest. So we'll start with SPY, but of course you can test different symbols that have data right now for 0DTE and 1DTE trading. You can test expirations. In this case, we're going to go 0DTE. Then you can choose your strategy. We're actually going to do an iron condor in this case. And you see when you select iron condor versus something like a long call spread, you'll get your different strike selections that'll start to pop out here. So if I do an iron condor, I get more strikes that I can choose. Here what we're going to do is we can select the strikes. Now you can do this using many different recipes. You can use a recipe for a delta, a dollar amount, or a dollar amount above or below the underlying price. A standard deviation, a dollar or a percentage above a different leg in your iron condor. So there's a lot of different combinations that you can kind of put together here. So for this example, we'll just go ahead and do a 30 delta short put spread or short put. We'll do the short call also at a 30 delta or closest. And then what we'll do is we'll use a different recipe to select our long legs, and that's going to be $5 away from the short put or the short call in this case. So for the long put leg, we'll do this one a dollar amount above and below a different leg. So here we can say $5 below the short put leg exactly. Now you can do different variations of this. Again, if you are testing things and there may not be a leg that's right there, sometimes that does happen with like SPY or TLT or IWM. There may not be a leg for that right there. So if you go out different lengths, you might have to do something like or closest or higher or lower. But in this case for SPX, I'm pretty sure we have those, so we can do exactly $5. And then on the long call leg, we'll use the same recipe, the dollar amount, but this time we'll do $5 above my short call leg exactly. So again, we'll do this here. So that sets up our iron condor. The next thing that we do inside of the backtest is we set our capital. So this is where we would set our capital starting for the positions. We can set it to whatever number we want. You can do 3,500. You can do 5,000. Set it to something reasonable, of course. We see too many people sometimes do crazy backtests that just aren't realistic for trading. They'll set starting capital to $1 million and position size to $500,000. You can certainly test it, but is it realistic, right? So set something realistic. So we'll do $5,000 here, and then we'll set our position size. Again, you can use a number of different recipes here. So you can set an exact number of contracts up to a certain amount of risk. So allocating up to $1,000 of risk. So get as many positions as you can up to a certain amount of risk, or a percentage of the total capital or total allocation. That way it kind of scales up and down as the strategy evolves. So we'll set this one something simple at just one contract at a time, a $5,000 allocation. The next area that we can fill out is the position entry. So this would designate when we would get into the position. So we would enter positions at a certain time. You can change this. You can say 10:45 or 10:55, whatever it is, you just set up that time right there. So in this case, we'll do 2:30 in the afternoon. We'll do 2:30 p.m. Eastern time. Trading days here, you can specify certain days of the week. So in this strategy, we'll just do all trading days, but we're going to go ahead and skip FOMC days. So that would be just a simple click of a button here. And then finally, for position entries, we are going to include at least 5 cents of slippage from the mid price for opening trades. That's just a good technique that you can use in all of your backtests, is force some slippage in there. That means that the test is going to be a little bit tougher on filling trades. It's going to be a little bit more realistic when you actually start transitioning to live trading. You don't want to include no slippage in here. That just means that when you transition to live, you might get different fills here. So you can start to be a little bit aggressive with your slippage. Obviously, the more aggressive you are with slippage and the better the test performs, the more resilient that test might be for you when you go live. The next thing we can do here, and these are all optional fields. So notice that these fields up here, when we kind of set up our backtest, we have to set up these fields. We got to know the capital. We got to know how we're entering positions, the type of strategy. But from there, everything else is optional to add on to it. So you can run this test right now. We could just run this backtest, but we can include some optional things for different fields. So the first thing that we can do is here in this position criteria, We can include some optional fields for the mid price has to be a certain price. The risk reward ratio has to be a certain ratio or higher. The bid-ask spread has to be a certain bid-ask spread or less. All things that we're going to test out here in the video. I'll show you those here in a minute. Entry filters, we can add some indicators or ranges. So we can add VIX ranges or IV rank or changes in the underlying security. We can add a bunch of different indicators. We can add some moving averages. So you can see how you can layer on top of this different ways of testing. So you've got kind of your base strategy, and then you've got some entry filters and position criteria that it's got to meet. And then likewise with entry criteria, we would of course have our normal exit options. So these would be things like profit taking. You can do 2 consecutive hits at a profit target. Again, this would be more aggressive for testing to make sure that it's not just a random fluke of pricing, but that pricing was there consecutively. So you can do profit taking, stop losses. You can remove positions a certain time before expiration. So say 10 minutes before the market closes or an hour before the market closes. And you can do multiple of these at the same time, which again, we'll show you all sorts of examples in this video. And then of course you can do things like touch, like if the underlying is a certain dollar amount from being in the money or less, you can do those kind of, again, advanced exits. And same thing here with exiting and slippage. I always include personally in mine, I always include entry slippage and exit slippage as a base for everything. That way I know I've got some slippage included and I kind of play around with that for different tests. But if you do nothing else on just a base run of a back test, definitely include the slippage. And then finally, we can choose how long we want to run the back test. We'll do 3 years here to get a lot of data. That way we have a lot of data to work from, and then we can run multiple variations. So for this first run of this back test, just to give us a very simple baseline here, we're just going to run this core strategy. This one's going to be entering positions at 230, holding them basically until expiration because they are SPX. So we can hold them till expiration. They're cash settled. We don't have to worry about it. And then just including some baseline slippage here and seeing what we get. So once we click run backtest, the backtest will start to run here. You go over to your screen. You might see this running, depending on how complex your strategy is. Might take a little bit of time to run, but once it's finished, then you'll get the results here on the screen. All right, so now that the results have populated, now you can see the results of this backtest, right? You can see the P&L chart here, and then you can also see all of the different stats. So here on the top of the screen here, you can see some of like the total, more broad stats like max drawdown, your profit factor, your highest P&L, your lowest P&L, your maximum risk. This is a really cool one because maximum risk basically shows you at any point what was the maximum amount of capital that you risked. And so we started this strategy, this example one here for about $5,000, but at some point we risked a total of $2,680. So that gives you a good idea of kind of where that strategy might fit and how much risk you might be taking, or at some point you might have to weather that storm because the strategy did or was an overall winner, but you did have to take some risk along the way. You also see a lot of position metrics here. So in this position screen, these are position metrics. So not only the count of the number of positions that it got into, but you got your win rate, your wins and losses, your best win and best loser, your win streak and loss streak, always one that I take a look at. It's always important to see that. Are you in a strategy where you have 25 losers in a row before a winner? Are you in a strategy where you have 25 winners in a row, but you could have a couple losers? It's just a good idea to get a sense of what type of strategy you might be dealing with and how that might be, how you might deal with that strategy when you start trading it live, how you might have to go through that. And then you get your filtered trades. All of these position counts are also clickable. So when you do your position count here, you can see all of the different positions and you can click through to any of the positions and see the information for that specific day. So all of this history and all of these logs are right here for you. And you can also see filtered trades. So this is really cool because you can see why it didn't get into certain trades. In some cases, it would be some of your filters like FOMC. It could also be just pricing issues. Sometimes there's pricing weird anomalies that happen in pricing, and we filter those out automatically for you if there's no option available. Like in this case, there was no long call leg that was exactly $5 away from the short call leg. So we couldn't actually enter position for those days. So these are really interesting to see, and we'll see more of this as we get through this video and so show you more examples, but it's really cool to see why positions were filtered out. And then down here on the bottom, you have your position averages. So you have your P&L, your average risk, Your average premium that you collected is an important one, right? Your return on risk, your reward to risk, etc. And then you've got the exits. So in this case, we set all of these trades to expire at or go all the way to expiration. So they all expired. And then finally, we can open up this monthly P&L chart here. And this table is really fun because, again, it gives you a sense of just understanding what you might go through as you actually trade this strategy. So it's always fun to do a back test and look at the total P&L and be like, oh, this is a good strategy. But you have to live through that for 3 years as a trader. So try to give you as much information as possible to show you what it might be like to live through that. And in this case, if you just even go back to 2002, if you started, or 2022, if you started this strategy in March of 2022, you had 3 losing months in a row. And so right off the bat, your win rate is not what the strategy was long-term, but was really bad for those 3 months, right? So for those 3 months, you made a number of trades where it just didn't work out, right? And if you quit at that period, then it probably wasn't right. It probably wasn't a good time to quit. You quit right at the beginning of probably a good period in the strategy where the next couple months were all really, really good. So it seems like this strategy does have a little bit of ebb and flow where it goes through a couple months of losing and then it has a couple months of winning. And then you go through different periods again where you have a couple months of losing, you have a good month, losing month, a couple of winners, then you got some losers, right? So it definitely seems like it ebbs and flows. That's okay. Again, you can see this visually here in the table, but it's also good to see just kind of the ebb and flow of the chart on the top. Now on the right-hand side here, you have obviously the settings of your strategy. So this is all the settings for this strategy going all the way down, all your position criteria, all your stuff here. That's right there on the right-hand side. So it makes it super easy to see. And from here, what we can do is we can do a lot of different things. Number one is we can create a new back test from these settings and just test a completely new setup using these settings. That will get you to a new blank page to start. We can edit this backtest. So if you like this particular backtest and you just want to rerun it here as one single edit, you can edit it. You can, of course, delete this backtest, and you can share this link with your friends or traders. So I'll put a link to this one in the video right below here so you guys can see this one. So I'll copy that to my clipboard real quick so I have it. And then you can also create a bot from this backtest. So we'll do that here in a bit, but I want to show you how you can actually create more variations to test a lot of different things side by side. So what we're going to do is we're going to actually click this button here, which is to compare. And what that's going to do is it's going to throw us into a quick new screen where we can compare up to 5 different versions or variations of this backtest. So what I'm going to do is I'm going to click on the 3 dots next to this test, which we're going to call test number A, and I'm going to add a variation. And when I add a variation, it's going to bring open our backtester basically screen to set up our backtest. And I'm going to get all of the same information from this backtest, and now it's going to populate it in here, and I can basically change anything or add variations to it to test different variations. So for example, if I want to come down here and let's say I want to add one of our position entry criterias, let's say I want to ensure that the mid price when getting into a trade is 250 or higher. So I'm going to put it in here as the mid price is 250 or higher. Now you remember from the current test, I think our mid price, our average premium collected was about 230. So the assumption here might be something like, and I'm just giving you examples, well, I want to make sure I collect a little bit more premium. Maybe if I collect more premium, I might not trade as much, but will those trades be more stable? Will I have better drawdowns, maybe better win rates? Maybe collecting more premium means wider break evens, right? So I don't have to worry about that as much. So I could just make that simple change right there. And then what I do is I go down here and I run the test. So that one ran pretty quick because we already had most of the data. We could just filter it out by price. But sometimes if you're adding a lot of complexity to a new variation, it might take a little bit of time to run. But you can see here in this example that test B did not perform as well. I mean, it made money. It was still a money maker. It was good. It did have a little bit better profit factor. And you can see here that the max risk was a little bit better profit factor. We did actually have a worse win rate on this strategy, which is very interesting, actually collecting a little bit more money, getting into less trades significantly. You can see 703 trades versus 163 trades. So we got into significantly less trades, and it was reflected in the total P&L. So it was still okay. You could still probably run this strategy if you wanted to. but it didn't seem like it was as good as strategy number A. Now we can even go even further on this. Again, add another variation. So let's add a bunch of different variations here. Let's just go, just for the sake of argument, let's go up to something really high. Maybe we can get into positions that are super, super good with really high win rates. If we go up to a premium of 275, I think that might be tough to get into, but we'll see. And yeah, you can actually see right here, it was pretty tough to get into it. It was a winner, made $116, woohoo, right? But it only got into 21 trades. So you can see right there, it's just, we're just too aggressive on those filters. And this will happen. The reason I want to show you this is because sometimes when you backtest, there is this fine line where you do have to make a lot of variations and tests, but of course go crazy with it. You know, you can test as much as you want here. But there's a fine line of adding too much to it that you just don't get enough trading results, right? And so here you can see we got most of our trades were filtered out because of the premium. So you can see here 682 of the potential trading opportunities had a mid price that was too low, right? Just wasn't high enough. And these are actually decent prices. Most of these are pretty decent prices. Maybe we want to do like a low level filter. I can just see this right here. Maybe we do a low level filter in one of our variations that, you know, kind of filters things out below 185. Maybe that's too low. You know, that'd be an interesting one to test. But again, you can see how these variations play out. So let's keep going here. Let's add another variation. So in this case, let's actually remove the mid price one. Let's just keep out a low level filter. So we'll actually just keep this one at 200. Remember, just keep out those low 180s, something like 200 or even maybe like 215 or something like that. Something that would keep out, you know, lower premium entries. Maybe that improves it. But let's also add an indicator here. So now let's do one where we're going to add an indicator. So we have our position criteria. That's the individual position. But now let's add an entry filter for an indicator. Let's do RSI. It's one of my favorite ones. Let's assume that we only want to enter positions when RSI is between 30 and 70. So you can see the allowed range here that we're giving it. The current reading for SPX right now is 34, just to give you a frame of reference. But the allowed reading is between 30 and 70. So the assumption here would be, and again, this is just my assumption, I'm giving you examples of how to do this. The assumption here would be if RSI is too high or too low, maybe the market's going to turn really quickly, or it's super overbought, super oversold. So we kind of want stable ranges for this iron condor. So we're going to test RSI ranges 30 to 70. And the way that I do testing, and I'm hoping I explain it nicely in this video, is I do it in progressive steps like this, where I'm slowly adding and incremental improvements or removing those. Sometimes I see that people will add completely wild variations, which of course are your choice, but you don't know what's actually moving the needle or not. So I prefer in my testing to make slow incremental adjustments, like add a filter and then remove a filter and add a different one, or slowly increment them so that I know what's actually driving the changes. So we'll run this test here and see if it gets different results before we continue. All right, so you can see test number D popped up here. Again, this test is our RSI test. By the way, you can at any point click on the description of that particular test and you can give it a better description. So we can say RSI 70, 30 to 70. That way we know what that test is. Like this one here, we can say entry price of 275 or more. I think this one was entry price of 250 or more, 250 or greater. Again, that's just an easy way that you can see here as you're adding and moving variations what the differences are. You can of course just click and open these and see what they are, but sometimes I like to put this in here as well just to make it a lot easier. So test number D here, again, you can see better than test number B, which was just changing the entry price. So we did filter it by, you know, some entries. So we'll go down here and we'll see what got filtered out. Mid prices, we still filtered out about 210 trades. That was a lot of trades that were filtered by mid price. About 62 were filtered by RSI. So it might be worth, in this case, going back and maybe removing that entry filter and testing it just purely with RSI. So let's do that here. We'll add another variation. And this is how I would do it myself if I was doing it. I would just remove that. You can remove that entry price filter. So now we are going to do all entries only filtering for RSI in this example to see if just getting into more trades naturally and then curbing those high, RSI readings or low RSI readings make a difference. So we'll actually change this title here for this one so that we get a different one. And we'll also say entry filter of, I think it was 215, something like that. You guys, I'm sure, correct me in the comments if you're watching this here. Okay, so that actually performed better just removing that entry filter and just purely focusing on RSI. Okay, so this is very interesting, right? This is how we start to build strategies. Now, it doesn't necessarily beat out the baseline model. So the baseline, just enter positions, let it go all the way to expiration, still did really well. But again, we can start to modify and see how these things move differently. So we're going to actually remove these ones. You can remove tests to kind of make room for more testing here by going to the side of any of these tests and going to the remove test button. So we'll remove these entry price tests because they didn't really make any significant difference. That slides these two tests up into position B and C, and then we'll add another variation here. Now this time what I want to do is I want to test something completely different. So we're going to remove the RSI test, and this time we're going to test the opening change of the market. So the assumption here with the opening change is that if we have days where the market has a big open, like a big upward move or a big downward move, it might be days where it's not a good day to trade an iron condor. That's the assumption. So we don't want to trade an iron condor maybe on those days where we get a big opening move. So right now the market's open move today was about 2.24, so pretty middle of the range. But let's just say we don't want moves bigger than -1% or greater than 1%. So this might be limiting. We might get less trades, of course, but the assumption might be we get into better trades over time, and that's better for the strategy. So we'll do opening gap or opening change of -1 to 1%. And we'll see what that gets us for this particular test. So this one's going to be interesting. Again, this is how I would do it. I'm hopefully going through this. This is exactly how I would run these, kind of step by step. I would do like a baseline, find something that works, and then slowly start adding and making changes to try and improve it. Okay, so this is pretty interesting. So C and D. C here is on our chart is purple. That is the one that's purely RSI driven. D here is opening range is less than 1% up or down on the day. Ultimately, D had a better total P&L. So if we look here and just kind of compare these side by side, D had a better opening or a better total P&L, had a slightly better profit factor. Also, the max drawdown and the max risk were a little bit better. It had a slightly better win rate. You can see it actually even traded a little bit less on D, which we knew kind of would happen here as we get into less trades. So if you just look at that purely and you go down to even some of these averages here, you can see the average P&L was about $16. You had a little bit less reward risk, but that's okay. You probably got into better positions. The average loss was about the same, about 231. So it looks like actually, given those numbers, they performed very similar. You can see they actually track each other very similar on the chart also. Almost like side by side, it seems like very similar kind of tracking. But if you were given the choice, you'd probably want to go with D versus C, right? So that's what you would do here. So let's add one more variation here just to kind of round this out. So let's keep going with this current variation, which is the entry here of -1 to 1%. And let's add one more indicator here, or not indicator, I'm sorry. Let's add an exit option here and start to test some different exits. So in this case, let's go ahead and test maybe getting out of the position halfway through. So if we get 50% of our initial credit, so if we sell it for 250 and it's down to 125, then remove the position, which would exit it before expiration, obviously. So you'd want to make sure you can do that in your account. And we're definitely going to require 2 consecutive hits at that profit target. That just ensures that it's not just a blip random trade or random pricing where the market kind of showed pricing, but it wasn't really there. That can sometimes happen. So if we require 2 consecutive hits, then that means what it's going to do is it's going to only start exiting the position or try to exit the position after that second attempt. So we're definitely going to do that. And we're going to increase our slippage just a little bit. So the reason that I want to do this here, and this is purely a stress test type of thing, is that It doesn't necessarily mean that we're going to get 10 cents of slippage on exit. But if we force the strategy to include 10 cents of slippage from the closing trade, and the strategy performs better than everything else, which I don't know because I've never tested it, then it means that it's pretty resilient. And if we get better pricing in the live market, then we're doing really well. So I'm going to force a little bit more slippage on the exit. And then here we'll do 50% profit as our description so we know what it is. And then I'll go ahead here and run the backtest. Now this one might take a little bit because it's going to have to calculate all those backtests as we go, but it will be interesting to really see if this improves performance or not for this strategy. Okay, so you can see the new strategy result is up, and it is slightly lower than those C and D variations with RSI. In particular, if we even removed some of these ones, so let's just get this one out of here for now. We'll remove this variation. We'll also remove the RSI one. Remember, the open entry range is a little bit better, so we'll just kind of focus on these two, kind of get the clutter out. But the B and C version here, this is our new one that we ran with 50% profit targets. You can see it actually underperformed at the end, but in some places it was actually a little bit better than the strategy. Some places a little bit worse. So let's dig into the metrics here and see what we can find. So if we look at the stats, we know that it performed a little bit worse. Actually, the max risk was a little bit higher. The max drawdown was higher. The profit factor, a little bit better. Win rate was significantly better. That kind of makes sense because we're getting out of positions early. So it would make sense that we have higher count of winners because we're exiting some positions early at 50%. But it looks like we didn't leave enough room to let positions kind of go all the way to expiration, and there was value in doing that. You can see that here reflected in the averages because although we had a higher win rate, our average P&L on the trade was actually less. So that means that we took off winners that could have conceivably been even bigger winners and would have helped the strategy overall. We really didn't do anything to help our average loss on positions. And actually, if you go back up here, you can see we started to get a real change here in the win streak and loss streak. By taking positions off early, we had our biggest win streak, which was 14 winners in a row. And so this is actually important. Like I said before, it's giving you an idea of how you might have a strategy that starts to behave where you get a lot of winners in a row. That if you like that for your strategy and you want to do that, it feels good. By all means, that's how you would do it, right? And then down here, now with the exits, you can see here that we saw that 305 of our trades were exited for profits and 288 were exited by just letting them go to expiration. They never reached that 50% profit to be able to take those positions off. So it's very interesting results here. Again, it probably didn't improve it significantly, so you might want to test some different variations or different ways of doing it, but hopefully this kind of shows you a lot of different ways that you can do variable testing for your strategy. Now, once you're good to go here and you find a strategy that you like, let's say we're just going to use strategy number A, which is still the one that I'm using for my live account right now. I still haven't found anything that's significantly better. I'm still testing variations. But if you like a strategy and you want to start to trade it, then all you would do is go to the three dots next to that strategy, and you would go down here to create a bot. Now, what it's going to do when you create a bot is it's going to take all the information that you just tested already. So you do the heavy lifting of testing and doing the variables, right? Do that first, spend your time there, then just automatically create a bot, takes all that information and generates a bot for you based on that backtest. So you can do something like SPX, afternoon, iron condor, or whatever you want to call it. You connect it to one of your live accounts, like your Schwab account, Tasty Trade, Tradier, TradeStation, whatever works for you. So I'll do Schwab IRA here. You give an allocation, it'll use that same allocation unless you change it from the backtest. And then down here, you're going to set your entry time. Now, this is where you can be a little bit flexible. This test was run at 2:30 every day. I like to open positions in a time range around that same time. So I probably won't give it a super wide range, but I would give it something like 2:20, 2:15 to about 2:45, right? So you don't want to go super wide that it kind of wrecks the strategy. You don't want to say 11 o'clock to 2 o'clock, right? Well, that's not what you tested. You tested around 2:30. But by doing this, you give yourself more opportunity for it to try to enter positions if it doesn't get filled right away, or maybe if pricing is not there exactly at 230, maybe at 231, there's better pricing and it meets your criteria. So you definitely want to do a little bit of a range around there. That's what I would do. That's what I do with my strategies. But you don't want to go too wide. So maybe 15, 20 minutes on either side, just to give it a little bit of movement around the market. And then finally, you just confirm your trade pricing. Again, we tested here 5 cents of slippage from the open for this one and 5 cents of slippage from the mid for any closing trades. We're still going to let it go all the way to expiration, but if we start to introduce a profit target on this one, then we would use that. And then we simply create the bot. Now the bot literally just got created, and when you go to the bot settings, you can see your new bot here is created. You've got your SPX Afternoon Iron Condor. It's connected to your Schwab account. It's got your allocations in here. You can change your scan speed. So I'll set this to 1 minute since it's a 0DTE strategy. And you have your new entry scanner, which is already set up to run between 220 and 245. If I open that, it has all of the decision criteria in here. So can the bot open a new position? Did it pass my market criteria? So the only one on this one was it's not an FOMC meeting today. So if you had other market conditions like VIX or change, those would be in there. And then it's going to open a position. And you can see here, it's opening the exact position that we tested exactly. So all of that information just gets transferred over effectively to your bot. And once you're good to go and you're ready, you just simply turn on automations and let this bot start running. So that's how you do backtesting start to finish, step-by-step guide. I hope you enjoyed lots of these examples. If you did, please let me know in the comments below. Like this video, share it. And also I've got links to a ton of these backtests in the description below. So please feel free to play around with those, create your own variations. And until next time, happy trading.